If you have $1,000 saved, the worst thing you can do isn't losing it. It's starting the wrong way and wasting years without realizing it. Most people don't lose money because they're unlucky. They lose it because their first decision sets them back before they even begin. In this video, I'll show you exactly how I'd invest $1,000 today if I were starting from scratch step by step. No hype, no trading, no complicated strategies. By the end, you'll know where the money goes, why it goes there, and what to do next. This video is for beginners, especially if you have a full-time job and you don't want investing to become a second career. If you're looking for quick wins or lottery-style stock picks, this channel probably won't be for you. But if you want a long-term system that works quietly in the background of your life, you're in the right place. $1,000 might not sound like a lot, but it's important for two reasons. First, it starts the habit. Second, when invested consistently, small amounts compound over time. According to historical market data from sources like Vanguard and Morningstar, the US stock market has averaged roughly 7 to 10% per year long-term after inflation, depending on the time period. The real power isn't the $1,000, it's what you do after. Quick disclaimer before we continue. This video is for educational purposes only. I'm not a financial advisor, and this is not personalized financial advice. Always consider your own situation or consult a professional before making financial decisions. Before investing a single dollar, there are two things you should already have in place. First, high-interest debt under control. If you're carrying credit card debt at 20% interest, that's a guaranteed negative return. Second, a basic emergency fund. Most credible financial research, including guidance from institutions like the CFP board, recommends 3 to 6 months of essential expenses in cash. If those two boxes are checked, you're ready to invest. Step 1 is choosing the right account, and this matters more than most people realize. A 401k is a tax-advantaged retirement savings plan sponsored by an employer that allows you to contribute a portion of your paycheck into an investment account earmarked for retirement. If your employer offers a retirement account with a match, that should usually come first. A match is an instant 100% return on part of your money. If you don't have that, a tax-advantaged retirement account like a Roth-style account is often the next best option, depending on your country. A Roth IRA, individual retirement account, is a tax-advantaged retirement savings account where you contribute money you've already paid taxes on, after-tax dollars. Because of this, your contributions and investment earnings can grow tax-free, and qualified withdrawals in retirement are also tax-free, as long as you're age 59 and a half or older and the account has been open for at least 5 years. And if neither applies, a regular brokerage account is perfectly fine. The key idea here is simple. Use tax advantages when available, but don't let perfection stop you from starting. This is where most people mess up with their first $1,000. They try to be clever. Day trading, hype stocks, crypto bets not because it's smart, but because it feels exciting. The problem is, that usually makes investing stressful and short-lived. Your first $1,000 isn't about getting rich fast, it's about building a system you can stick with. Now let's talk about what you're actually investing in. Instead of picking individual stocks, most long-term investors use broad market index funds or ETFs. Here are examples of the most popular index funds and ETFs. VT-SAX, Vanguard Total Stock Market Index Fund, a mutual fund that tracks the entire US stock market, including large, mid, small, and micro-cap companies. It offers broad diversification in a single fund. IVV, iShares Core S&P 500 ETF, an ETF that tracks the S&P 500, representing about 500 of the largest U.S. companies. It's commonly used to gain exposure to the overall U.S. large-cap market. SWPPX, Schwab S&P 500 Index Fund, a low-cost mutual fund that also tracks the S&P 500. It's popular for long-term investors who want simple, passive exposure to major U.S. companies. SPY, SPDR S&P 500 ETF, one of the oldest and most widely traded ETFs, tracking the S&P 500. Known for high liquidity, it's often used by both long-term investors and active traders. These funds own hundreds or even thousands of companies at once, spreading your risk automatically. According to multiple long-term studies, including the famous SPIVA reports, the majority of actively managed funds failed to outperform simple index funds over time. That's why long-term investors prioritize diversification, low costs, and consistency. Let's make this practical. Here are 3 simple ways to invest $1,000. Option 1. Aggressive, long-term. $1,000 into a broad stock market index fund. This makes sense if you have a long time horizon and can tolerate ups and downs. Option 2. Balanced, $800 into a stock market index fund, $200 into a bond or conservative fund. This reduces volatility while still allowing growth. Option 3. Conservative, $600 stocks, $400 bonds or cash-like investments. Better for shorter time horizons or lower risk tolerance. None of these are right or wrong. The best choice is the one you can stick with. Once you've chosen your allocation, the mechanics are simple. You deposit the money, search for the fund, and place a buy order. If investing all at once feels uncomfortable, you can spread it over a few weeks. Research from companies like Vanguard shows lump sum investing often wins mathematically, but behavior matters more than math. The best plan is the one you actually follow. If this video is helping you, consider subscribing. This channel is about long-term investing, clear thinking, and building wealth without stress or hype. If that aligns with how you want to invest, you'll probably get value from what comes next. Investing doesn't end after you click buy. The most important step is automation. Set up a recurring contribution even if it's $50 or $100 a month. Numerous behavioral finance studies show that automatic investing removes emotion and dramatically increases long-term success. Consistency beats intensity. Finally, let's talk about what not to do. Don't constantly check your portfolio. Don't chase hot stocks. Don't panic during market drops. Market volatility is normal. Historically, markets have always recovered over long periods, but only for investors who stayed invested. Boring investing is often the most effective. Investing $1,000 isn't about getting rich quickly. It's about building a system you can repeat for years. Wealth isn't built by big moves. It's built by not screwing up small ones. If you haven't watched the first video on how to start investing with a full-time job, that's the best place to go next. That video explains the mindset and structure that makes everything we discussed today actually work.